Welcome to your single source for insight, inspiration, and unfiltered conversation in financial services. In each episode, we'll talk to the disruptors driving innovation, unpacking the market trends, strategies, and the stories behind the numbers. Follow and subscribe to stay at the forefront of global finance.
Hi, and welcome to the Single Source podcast. I'm Heather Zumaraga, and I'll be your moderator. Today, stablecoins are in the spotlight, shaping the future from regulating to distributing. I'm joined by Chainlink Labs advisor, Dr. Rhys Bidder, and commercial head of Apex Digital, Angie Walker. Rhys, I want to kick things off with the basics. Stablecoins have emerged as a means of providing decentralized monetary access, but they're also one of crypto's hottest topics. At a very high level, can you explain what is a stablecoin?
Yeah, it's great to be on this podcast. Thanks very much. And I'm happy to speak about this topic. Yeah, stablecoins are money for the blockchain age. Okay. Now, you may say we already had money in the form of like Bitcoin and Ethereum and Ether. But this is a form of money that has a lot of the characteristics that we want from money, very stable in price. You know, the clue is in the name. Okay. So they emerged as a type of on-chain money to satisfy our desire for, an asset that has a stable price, which can then be used as a settlement asset at scale. Okay. Used as money in the way that we might use other monies. Okay. The aim of the game is for them to be backed by high quality assets, which allows the issuers to promise that, effectively on demand, you can get back a dollar, a traditional dollar, a dollar in your bank account. Okay. And that anchoring to that reliable backing asset should allow the stablecoin to retain its peg, the link to the $1 one coin, okay, that everybody wants. Okay. And of course, there's a lot more to it than that. But basically, the combination of these solid backing assets and the promise to redeem should keep its price pretty much at one, in all contexts. And as a result, it's become really, at the moment, the only game in town for cash on chain. There may be other things coming, tokenized deposits, deposit tokens, maybe other things. But right now, it's the main go-to way of settling. So in theory, they're great. They fly around the world. They settle through the internet on the blockchain rather than going through lots of banks or lots of central banks' payment systems. Okay, and in theory, they seem terrific idea, and they are growing. But as I think Angie will talk about, the reality of actually getting them to work, getting them to be reliable, getting them to be safe is another issue.
Yeah, no, I appreciate that because there may be a gap between the theory of stablecoins, but the reality, as you just mentioned, may be much more complicated. So, Angie, if you want to pick it up there, talk about there's a world of complexity, right? How do we solve for scalability, privacy and security, compliance, audit, reporting, all that fun stuff? It's a lot more complex.
Yeah, no, Rhys is absolutely right. They are effectively a form of value. They're being moved on the through blockchain. It doesn't make them any less important in terms of their industrialization and their privacy and scalability than any other mission critical payment infrastructure. Just because it happens to be on chain, it still requires the same level of industrialization and resiliency that we have within our global payment platforms and payment systems today. So there is a world of complexity. Rhys is absolutely right. Anybody who is entering the world of licensing and becoming a regulated stablecoin issuer will face that world of complexity. What we've tried to do at Apex is we've tried to build out an infrastructure and an operate model that will allow them to be a licensed stablecoin issuer without worrying about the complexity that comes with that. And that complexity comes in a number of different ways. It comes in the operate model. It comes in how you control the level of stablecoins in circulation relative to the backing. And we'll talk about that maybe a little bit later on. And it comes in things like the governance and the privacy and integrity of the infrastructure itself. So we've spent a lot of time looking at how can we take the infrastructure we have today, which services over 10,000 customers in 50 countries and manages 3.5 trillion of assets under administration. So we looked at that infrastructure and we've made some really significant changes to increase things like the the operate window, and we'll talk about that maybe a little bit later on, and to talk about the velocity of how we operate to make sure that we could actually deliver a sort of a complete service to any issuer without them having to stand up all of this infrastructural complexity for themselves. So it's a very interesting area, but it's as challenging as standing up any other mission critical infrastructure. And we think we're very well placed to do that for anybody who's looking to issue licensed stablecoins.
And Rhys, how are financial institutions approaching stablecoins? Aside from the numerous ways that Angie just articulated, that Apex Group services the digital asset space in general, as an advisor to Chainlink Labs, what are you seeing in terms of the regulations?
Yeah, I mean, the first point is they are now approaching this topic. Go back a couple of years ago, people were wondering if institutional money would come in at scale. Okay, and there have been various changes, particularly in the US, but not exclusively in the US. Okay, and now stablecoins offer, lower cost, transparency, predictability, perhaps increased liquidity one day. And that's all well and good, but you sort of do need a regulated framework. At least these sort of institutions do need that. And since that regulated framework has started to come online, they really have pushed more into these things. Payments is probably the first place you would look. Very significant, traditional, well-known financial institutions, MasterCard, Visa, some of whom, partner with Chainlink, Stripe, for example, these big beasts of payments. They've come in and they're exploring how it might enhance the efficiency of their business, in particular cross-border. I mentioned earlier they don't go through quite the same systems, the same banking rails, the same central banking rails that traditional cross-border money flows use, but which can be a source of frictions, delays, randomness. Okay, so there's payments, of course, but there's other implications of stablecoins beyond just payments per se. They'll be the cash leg of a much richer set of transactions and applications. Okay, so from collateral, for example, now you would have a very safe and stable collateral that you can access very rapidly. It will speed up the velocity, and Angie mentioned velocity, with which you can borrow and lend during the day. And importantly, there are lots of tokenization applications springing up at the moment. Okay, now tokenization is about other assets, not money assets, but whenever you have one asset you're trying to buy and sell, you need money. So the institutions are really very interested in how they have, a complementary money asset for this other tokenization, stuff they do. And at the moment, they don't have CBDCs. At the moment, they don't have tokenized deposits yet at scale, although they are coming. So really, stable coins are sort of what you look for these on-chain developments, particularly in tokenization. They're very complementary to that.
Yeah, Rhys, just to follow up on that, looking to the future, I mean, there's the big debate over interest-bearing treasury, but we're not there yet, right?
Yes, I didn't mention. Yes, exactly. So large institutions, large corporates, have very important treasury functions where they hold sort of liquid assets ready to spend and so forth. Now, stablecoins at the moment, can play that role, but they might increasingly play that role if, when you hold a balance of stablecoins, you could be earning something on it as well. So there's a very, agitated debate about this, whether or not stablecoins should pay interest. Some stablecoins, sort of outside the regulatory perimeter, are already some of the more DeFi stablecoins. But as Angie emphasized, we're talking here really about the sort of stablecoins that institutions who are regulated will be looking at. And until the regulators get somewhat more comfortable with yield-bearing stablecoins, there's probably going to be a bit of delay. The idea there is fairly simple, is that a stablecoin, as I said earlier, holds a lot of typically fairly low risk assets. You mentioned US treasuries would be the key example. They pay a yield. At the moment, that yield, in some sense, goes into the coffers of the stablecoin issuer. Okay. And some people feel that maybe some of that yield will eventually, perhaps not should, but will eventually be passed through to users. Okay. But until that happens, I think we won't see that use case. You won't see them vast amounts of stablecoins being held in treasuries because, you're giving up yield that you could get if you held them in some other form.
Interesting. The goal, as I've heard, is really to reduce cost. The ultimate goal: greater predictability, transparency, automation, in terms of regulating stable coins or digital assets in general. But Angie, what needs to happen for these systems to scale effectively? Maybe how is Apex Group helping to address that challenge?
Yeah, it's a great question, Heather. So if you look at where Apex has traditionally had its business, obviously it's very well known, and it is the biggest independent transfer agent in the world. It operates in 50 countries, licenses in 32 different jurisdictions. What we have today is a 20-year heritage of transfer agency, fund administration, and corporate services, along with a very healthy banking license. So we've got a very established infrastructure which has been built for traditional funds. So what we've done is, and we've been maniacally focused on doing this over the last 12 months, we could see this wave coming towards us, which we knew that once the Genius Act was in place, that we would see a very large exponential growth in adoption, not just in the US, because we'll see it ricochet around the other super regulators the world over off the back of the Genius Act and hopefully very shortly the Clarity Act. But what we've done is we've prepared ourselves. We've put a lot of investment into the operate model. So we changed the operate model. We've lifted it right up so we can now operate 24/7, 365. Why is that important? Because a stable coin is very similar to any other. I mean, it's a cash equivalent. Effectively, it's the same as cash. You've got to be able to move it instantaneously, and that also means the on-ramp and the off-ramp. You've got to be able to continually be able to issue and redeem those coins in operation 24 hours a day, just like any other form of cash. And so we've lifted our operate model. We're now able to support that operate model 24/7. And in doing that, we've had to lift our back end, so the sort of the cash and the collateral management piece of that. So we now have to monitor not only the number of coins in circulation, and we do that using Chainlink's proof of reserve. We actually monitor and ensure that we aren't over minting the number of coins that are in circulation. That's super important for consumer confidence. But the other area that's very important for consumer confidence, and this is off the back of probably some of the early stablecoin use cases that were, as Rhys quite rightly said, much more DeFi oriented and more of a retail nature. The other thing we've had to address is the proof of reserve element, and making sure that the assets and the collateral that back those stable coins are commensurate with the value of the number of coins in circulation. So we use proof of reserve in two ways. We use it, one, to ensure we don't overmint, and we use it in a second way to ensure that the assets that back those coins, which typically in a licensed world in a regulated world will either be fiat or high quality liquid assets, because that's what's stipulated by the regulators within the various jurisdictions. What we do is in real time, we monitor the value of those assets, that collateral that's posted to back the coin, to make sure that the face value is never less than the face value of the coins in circulation. So we're doing quite a lot of different operational things, 24 hours a day, 7 days a week, constantly monitoring and administering the cash and the assets to ensure that we maintain a level balance between them on an ongoing basis. And it's these types of operations which we've been doing for many years in our fund administration and transfer agency world, which we've changed the operate model and the cadence of to accommodate things like stable coins and money market funds. So we feel really in a very, very privileged and exciting position where we believe we can offer a best-in-breed service for any licensed stablecoin issuer.
I think a point to make is that these financial institutions are very sophisticated in a lot of their business models, but then and their various sort of sub businesses, but they may not want to handle all the nitty gritty details that goes into issuing a stable coin. Okay, it's one thing to be the issuer, like you're carrying the can and it's your responsibility to redeem or to have the assets to redeem, but to all of the administrative tasks around it, that service may not be done per se by those institutions, maybe bought in, from providers like Apex and so forth.
Right. No, I really appreciate that. It's more complicated, as Angie was stating before, than you may think if you're entering the space. And I do think it's important to highlight that 24/7 capability. People want their money now, right, Angie? Like they don't want to wait. I remember it's like T+3, then T+1, and everyone's all excited, but no, we want our money like right away, and stable coins are allowing us to be able to do that, right?
Yeah, it makes a big difference. It sure does.
Yeah. So, and you mentioned the Genius Act being a major development in the U.S. So, Rhys, that was despite a slow start here in the U.S. That was a very important step. But please talk about the UK on the other hand for a moment. They're a bit further behind. Why do you think that is? And maybe focus on those two jurisdictions, the U.S. and the UK. How do their regulatory approaches compare?
Yeah, I think yes, I would say the UK is now increasingly people feel is a little far behind. I mean, to give credit to the regulators and policymakers here, the UK has a lot to lose in the sense that it has for decades, centuries perhaps, punched above its weight in terms of being an important financial sector. Okay, so if you start from a clean slate, to some jurisdictions, you can in some sense move faster. So I think perhaps a deliberate approach was appropriate, and the Bank of England, of course, is known for being very deliberate. But yeah, I think at the moment, there is pressure and a need for things to move on. There is a roadmap. Various regulatory institutions, the FCA has put out a roadmap. They have a lot of very clever people thinking hard about this. So within the coming year, one would expect to see a little bit more sort of substance. They're consulting at the moment, but the roadmap has at least put sort of dates on when certain things should be completed by. The government is obviously pushing quite hard. There's been a statutory instrument of sketching out how regulations might look. And the Bank of England, which I would say is fair to say traditionally has been a little bit risk averse on stablecoins, has even begun to soften some of its stance, in how it might allow certain assets to back it, and in what context these might be used. Okay. Now, what I expect, I mean, those roadmaps are out there. I mean, I actually think personally, I think that it will end up looking more like the US system than, say, MICA in Europe. Okay. I think there's a general sense that the British government and Britain generally is trying to, stay coherent with the United States, massive financial system of these United States. Okay. I think this will extend to stablecoins as well as other areas. I would expect to have to look in many ways like Genius, very high quality liquid assets. Angie mentioned, I would imagine, the Genius Act, said, well, we should have cash, treasuries, maybe a little bit of repo, but not even sort of commercial paper. I actually think that's going to be something similar that we'll eventually see in the UK. Within that, you could maybe see the UK being slightly more risk averse on exactly which assets and how many and how much of them within a balance sheet is acquired. But I think it's going to be broadly quite similar. I think the UK will probably put more of an emphasis on consumer protection. The FCA has a consumer duty, which I think will feed through to that. And I think, judging by the way the bank has spoken about these topics, they will be a little bit more explicitly focused on enhancing the stability of stablecoins prices in secondary markets. The bank has for a long time complained that stablecoins are not always and everywhere $1 is one coin. They may be very close, and that, I think, in the US has been sort of accepted as good enough. But I think in the UK, there's still a little bit of a hesitancy as to whether or not, even small deviations are acceptable. But broadly, I think it's going to be very similar. I think not like MICA in the sense of not being backed by bank deposits as much. In Europe, the early waves of regulation suggested that large stablecoins should have quite large balances and therefore they're backing assets in banks. That's something that the Bank of England seemed to be a little bit averse to. They were talking about backing them with central bank reserves, and now as they're moving away from just reserves, I don't expect them to move to banks. I expect them to move to holding, high quality, sovereign debt and so forth and so forth. But broadly, I think it's actually going to look quite like the US. And there's a second question, which is even if they want to do something different, how can any jurisdiction really deviate that far from the United States? That's a bigger question that's currently reverberating around, around the world.
And let's turn to the UAE. Angie, maybe perhaps you can pick it up here. Like, why is the Gulf region becoming such an emerging force for digital currency innovation? Maybe as much as the U.S. and really becoming front and center.
Yeah, I think the UAE is a really interesting territory. I had the great privilege of working in that region for the last few years on some of the work they've been doing around innovation in CDBC. I mean, if you look at the UAE in particular, what they've achieved in the last 2 or 3 years is pretty breathtaking. They've passed no less than something like 41 legislative changes in 1 year alone to prepare themselves for launching CDBC. They launched CDBC 2 years ago. retail and wholesale in the same year. A number of use cases, that it wasn't just like one use case and wholesale; it was multiple use cases. So they were very advanced in the CDBC journey. I think they were the first central bank outside of Hong Kong and China to join Enbridge in production. So they now are able to route CDBC between central banks, between themselves and 4 other nations. And they published their stablecoin regs and legs last year. So they now offer their members the opportunity to apply for a license for regulated stablecoins that was issued last year. And the first batch of licenses, I believe, were issued about 6 or 8 weeks ago. So for me, the UAE represents a really interesting opportunity, of course, because of its location and the time zone it sits in. It sits beautifully between the northern and the southern hemisphere. I do believe they have the opportunity to become a very, very significant corridor for digital currencies. And one of the points I would make, and I'm looking at this thinking about how do we operate and service and administer on behalf of regulated stablecoin issuers. One of the biggest challenges that people will face, I mean, it is subject to regulation, of course, but if you can use those stable coins cross-border, then you have to be able to support that operation on a global basis. And that's really important. A stable coin isn't just a means of value to diffuse obligations within a jurisdiction. It's subject to the regulation and the license under which you issue. It potentially will be a payment mechanism the world over. And so you've got to be able to support and maintain that capability accordingly. And that's one of the things we've been working really hard on with respect to the work that we're doing at Apex. So this is moving really quickly. I think Rhys is absolutely right. I think the US government and the Genius Act will influence many of the other super regulators the world over, those that haven't already issued appropriate regulatory licenses. I think we'll see a number of them come on board very, very quickly. And my personal view is I think most of them will opt for a backing of either high quality liquid assets such as treasury or fiat, or a combination of the two. I don't think we'll see much deviation from that going forward. And that makes tremendous sense because, as Rhys says, you need to maintain that 1-for-1 ratio. And that's very difficult to do unless you're using true cash equivalents. And that really limits it. So I think it's a really interesting time.
I was going to say, and it's particularly important because at this point, stablecoins don't have quite the same traditional guardrails that other types of digital money have, or the deposit insurance schemes and so forth, which is partly why, as Angie says, it's absolutely vital that you have high quality assets. And if you're going to be transparent about your balance sheet, you better have good stuff sitting there when people actually take a look.
Right. And I remember I was recently at a digital assets conference, and it was somewhat not easy to get on chain, let's say in the US, for example. But the problem was, well, okay, that's great. You can now transact in the US to another US buyer. But how do you navigate jurisdictions? And I think uh, people going into the space are learning more and becoming educated, like myself, don't realize that every country and every jurisdiction has very different rules. And so it's not really easy to navigate across all those different regions, Rhys. So maybe you can touch on what kind of platforms or stable coins most likely to live on to help make this easier.
Yeah, absolutely. I mean, the stablecoins that are at scale and have been successful in the past few years are defined by really their global reach. You know, they operate on a permissionless public blockchain globally. Now, this is actually going to raise very difficult issues around whether or not these coins should be allowed within regulated platforms in particular jurisdictions. And handling how those jurisdictions will treat your global stablecoin is part of the complexity that Angie was talking about. And, you know, Chainlink's automated compliance engine, you know, would help with that, but you need some sort of solution because as we keep going back to this theme, stablecoins look very simple, but to get them to work at scale through regulated environments, certainly, it's very, very complicated. But to go back to the platform point, yeah, so they're on these public platforms. Now, interestingly, I would say a couple of years ago, maybe slightly more, a lot of people felt that for on-chain finance at scale, it wouldn't be the public platforms that would be dominant. It would be more that private permission platforms. And I think Angie has some professional background in these areas earlier in her career. Because there was this sense that people might not want, confidential, mission critical information to be flowing around these public permissionless blockchains. I think that attitude has changed quite a lot in recent years, because a lot of the confidentiality, privacy, the solutions you need can be built into the application layer. The sort of the software that's deployed on the blockchain can make your transactions secret, confidential, okay? Even if the blockchain remains itself public, you end up passing around sort of zero knowledge proofs and other wizardry rather than revealing exactly what's going on in the details of the transaction. So, and also you've seen people have become more comfortable, institutions have been becoming more comfortable with the robustness of the public chains, okay? And also, what do financial institutions care about more than almost anything else? Liquidity, okay? You want everybody to get together and you want to be able to sell stuff quickly and cheaply, okay? Now, public blockchains are a sort of convener for vast numbers of market players. Okay, so there are various reasons why your public blockchains have to sort of come back into fashion in some sense. It's not a complete opposite of what a couple of years ago was going on. When I said, well, a couple of years ago, everybody's talking about private ledgers and so forth. It's not that it's an either or. Okay, a lot of the public blockchains will play a very important role, but they will always probably have to connect with some private blockchains, maybe even not blockchains, ledgers that are on traditional financial systems run by traditional regulators and so forth. Okay, so we've gone to a rather hybrid world at the moment where public blockchains are more important than I think people thought they were going to be, but where private blockchains and legacy ledgers are still very important. This is where interoperability protocols like Chainlink really sort of provide a service, because you need that interoperability, certainly in the transition, and maybe longer term. And maybe the longer term, we will always have some private blockchains connected with public, and you need those to be interoperable. A good example would recently be, Chainlink worked with JP Morgan and Ondo to connect JP Morgan's sort of permission system with Ondo's, public system and so forth. I think we'll see a lot more of that going forward.
Yeah, they're two completely
Yeah.
different ledgers as well, which is quite interesting.
Angie, how do we connect them all? Like, where does a stable coin actually get created? How does it find its way? I don't know if there's a right way, but to the right users, as Rhys was saying. How do we connect it?
Yeah. So I think there's a number of places in which we have to solve for that problem. At its most basic level, if you look at some of the regulation around stable coins today, so take the UAE at the moment, that's only a domestic dirham denominated stable coin. You can't use that coin for cross-border payments today. I think it will come, by the way, but I think initially they wanted to control the circulation, and so they went with a domestic use case to start with. So there are a number of ways that we have to be able to solve that. And again, we've built this into the operation and the manufacturing and the administration of our stablecoin as a service offering. First of all, we have to be able to program the smart contract. So what we need to do is the actual coin itself needs to have a certain level of understanding around what it can be used for. And so you can actually program some of those commitments and limitations and obligations into the contract that's wrapped around the coin itself. So that's the first thing, and that's really important. We do that as part of the base minting and distributions, and when we create the coins and Apex provides that manufacturing capability within its offering, we're able to make the token, the smart contract that's linked to the token, actually have information that tells it there are certain things it must not do. So where you've got a jurisdictional barrier, that will be programmed into the smart contract. Where you only want to, for example, leverage a coin in certain types of use cases, that could potentially be put into the smart contract. And you could even, although I know there's debates around what implication this has on the face value of the coin, you could even limit the use of the coin to particular types of users or particular types of consumption. Now, I know we start to move towards the debate of, well, hang on a minute, does that mean the coin is still worth what it says on its face value, because you've now limited what you can use it for? So we won't get into that debate right now. That's a debate for another time. But you can program it into the smart contract. We can program it into the into the compliance, so we can actually set up rules. So we actually, Apex uses Chainlink as part of its stablecoin as a service offering. They're a crucial part of the overall offering. So we use their policy framework. They've got a policy framework within their compliance engine, and it allows us to set rules to say this asset can be used in the following jurisdictions by the following types of organizations. That might be just for institutional consumption, for example. And in the following way. So we've already programmed certain things in at the smart contract level. We can then program things in at the workflow level using the compliance capability. So we're actually policy statements that we're defining in relation to that asset. And then as Rhys said, with the cross-chain interoperability capability, you can then put almost like this final layer on, which says we can go to the following places, we can integrate in with other chains. And as Rhys says, you're absolutely right. In order for you to have widespread adoption of a stablecoin, and that's the thing that any stablecoin issuer is looking for, they want widespread adoption. It's not there to be used in some sort of small and exclusive community. It's there for a purpose, and the more widely they're adopted, the more valuable they become because of their circulation, in the sense that they become more industrialized. People become more confident about the use of them. Then in order to do that, we need to not only be able to integrate into other chains. We could end up minting on multiple chains and distributing on many. And that's another place where it's crucial that we leverage the Chainlink interoperability capability and all of the great work they've done in integrating into all these different chains. Let's face it, there is an endless number of these chains emerging from all different directions. But the other thing we need to do is be able to integrate with legacy technology. So we need to have on-ramp and off-ramps to other mechanisms. That could be for conversion to fiat. It could be for pushing that payment into some sort of invoice finance platform, for example. So again, really important that we built integration into traditional infrastructures as well. So we make this sort of frictionless, seamless flow of stable coins from chain to chain, from chain to legacy, from legacy back to chain. We've got to be able to support all of those different things. And we've built that into the whole service offering so that becomes a seamless part of the capability. And we have to acknowledge that we will need to, for many, many years to come, have the ability for blockchain to interact seamlessly with traditional technology. Those technologies are here for a very important reason, particularly within financial market infrastructures. And blockchain is not a silver bullet. It's very powerful in certain use cases, but it's not for everything. And so with this seamless integration and frictionless movement of assets and value is vitally important. And we've worked really hard to make sure we can make that work.
Yeah, I love hearing about the partnerships between Chainlink and Apex Group, for example. That kind of collaboration is exactly what's needed to bridge the gap between innovation and regulation. And Rhys, Angie mentioned the tech and the compliance, kind of the idea of building that backbone. So I want to talk to you about infrastructure. What are the key technical and maybe even non-technical properties that stablecoins need to be truly reliable?
Yeah, I mean, I'll set aside the deeper infrastructure of the blockchains. I'll leave that to the people who are trying to speed up Ethereum and so forth. But yeah, I did some work a few months ago looking at sort of, the current best practice of state of the art among, existing prominent stable coins, and thinking a little bit about, where it might go. I think there's a risk that, well, regulators and private sector worry about, which is you end up with a zoo of different types of coins, and that fragments liquidity. Okay. Now, in the olden days, digital monies was very little more than just a list of names with numbers next to it. Your name, your balance, my name, my balance, and so forth. And in that environment, you can't, no coin is any different really from any other coin. Okay. But now with smart contracts, coins will not just have that list of names and balances or addresses and balances, but they can do lots of other stuff. Okay. But should they? Okay. And if you have all of these different developers saying, well, this is a stablecoin, but it behaves very subtly differently from all the other ones, then Andrew alluded to this a little bit. If you push that too far, you might start to think, well, these things it's going to be quite hard for them to all keep the same value near $1. And remember, these things are supposed to be stable. Okay. So the question is like, is there a core set of standard operations that we should all coalesce around within a stable coin? Okay. The danger here is you don't want to make that core set of standardized operations too big, because you start then constraining what stablecoins could be. You want to allow people to develop random stuff, but you also want to have core agreement. And I think transparency, having functionality around transparency is absolutely key. Okay, proof of reserves you mentioned a few times, maybe even proof of composition. It's not just saying, well, there's this value of assets backing it, but I can actually tell you at high frequency which assets, where they're custodied, and so forth. I discussed a little bit about that. And as Angie noted, these coins are often circulating, either bridged or natively issued, on multiple chains. So when I'm asking how many coins, I may not mean how many coins on this one blockchain. I want to know how many coins there are everywhere. Okay, so I discussed a little bit about that in this research I did, and that's on the sort of liability side of stablecoin balance sheet. The asset side, proof of reserve, is very much about what assets are backing it. So you really want transparency about both sides. Automated compliance. This is hard to tell how much compliance should be put in the token, and how much compliance should be wrapped around a token, and how much compliance should be left for the various protocols. So we already have Circle, USDC, USDT out there. Okay, they don't have much compliance built into them at the moment, but we're seeing new stablecoin issuers emerge, and the question is, how much compliance do you build in, and how much do you leave for just the protocols to do? So I think where we see there's a reasonable chance of a standard emerging would be around sort of identity solutions, for example. It's very plausible that regulated stablecoins at scale need some sort of identity solution. Angie's implied it several times. You need to know, is this a regulated entity counterparty? Is this counterparty a sophisticated investor, and so forth? So it seems that having some sort of identity solution is rather important. That raises a whole load of complexity. Who onboards it? Who attests the identity? Chainlink has solutions in the ACE setup for that as well. Okay, and then also maybe, although again this goes towards maybe over-egging the pudding a little bit, but you maybe want a standardized approach to embedding non-identity compliance, rate limits. Can this coin be used in this jurisdiction or whatever? Okay, so those I think are the technical things that should be standardized. I also think standardization around fees. I think eventually, as stablecoin models emerge, we will see some operations of stablecoins incur fees. We should standardize how that is done. And we mentioned it earlier, yield-bearing stablecoins. How should that be done? Okay. So for core operations and things that are absolutely core to any reasonable regulated token, those are things we should start standardizing. Because if we don't, we'll start losing this opportunity to transform the international world of finance. If we just go back to every jurisdiction having multiple local favorites and slightly different coins, then we'll miss the boat. Okay. So that's key, and I've emphasized the technical, but the off-chain essentials that you alluded to as well. You have to, it's one thing to say, well, stablecoins are backed by treasuries, they're very safe. Yeah, but who holds those treasuries? Where are they held? Are they accessible? Is the custodian has proper due diligence been done with the custodian, and so forth? So that's really important as well. And I actually think there hasn't been enough global coordination among regulators on stablecoins. And this is exactly the sort of thing where you do need it. Global stablecoins will have their collateral all over the place. Okay, so any regulator who has that stablecoin circulating in their jurisdiction should be able to rely on decent, coherent standards globally wherever that stablecoin is issued, where that stablecoin is backed. Okay, so that those are the things that I sort of came up with. There's lots of other stuff you could start to design and say, oh, the stablecoin should have this, stablecoin should have that. But that's in some sense for the free market to decide. I think there are some narrow things around identity, transparency on balance sheet, and fees and yield that I think we should be trying to coordinate and coalesce
The
around.
challenge to have one high level cohesive structure, but at the same time, you don't want to limit innovation.
Yeah, it's a
Um,
difficult balance.
yeah, so this is just a way to how do we actually build trust in the marketplace? To your point, you're saying, oh, it's backed by treasuries, but what does that mean? How do you know the treasury that is
And I
backed
would make
by
a
is
small
safe?
and I would make a small point is that we've seen standards have been transformative for some of the successes we've had in the past in digital assets. ERC20 token, for example. So the question is, do we need something like the ERC20 token for stable coins? That's the sort of question we're asking.
Angie, you do a lot of work. You handle a lot of minting and distribution on chain at Apex, for example, but there's a whole activity of off chain activity as well that people don't really think about, kind of the behind the scenes that I know you work so hard on as head of digital assets at Apex Group. So, can you talk about that for a moment?
Sure, yeah, that's sort of what I consider like the engine room, or it's like walking into the kitchen of a very large restaurant where you see you've got this lovely serene setting at the front and absolute,
It's
full
really
on
going on
action
behind,
going on in
yeah.
the back room. I think it's really interesting. Rhys has alluded to it a couple of times actually. If you think about what we have to do in order to offer a service that's is complete to any stablecoin issuer, and by the way, it's not dissimilar for anybody who's an issuer of a money market fund. Money market funds have many of the same characteristics that stablecoins do when it comes to subscription and redemption, when it comes to the backing assets, and maintaining that one-for-one equilibrium between the fund or the coin and the assets that are backing them. So what we've done is a number of things. We have, if you just look at the basics, as Rhys said, we have to be absolutely sure as the operator and the administrator, not the issuer, but the operator and the administrator on behalf of the issuer. And we do this today for tens of billions of dollars worth of stable coins. We just don't tell people about it, but we have to be absolutely sure that the reserves that are in custody are commensurate with the number of coins in circulation. And we do that on an intraday basis. We're monitoring and administering the value and the quantity of those reserves, and monitoring the availability of those on an ongoing basis. And they could, as Rhys said, they could be in custody in one place, they could be in custody in a number of different locations. It's absolutely, as the operator and the administrator, it's our responsibility to our customer, who's the issuer, to make sure we have consistently monitored those reserves to make sure they are compliant and commensurate with the values of those coins in circulation. We also calculate the value of the reserves, and we publish that on chain. We use Chainlink's NAV capability to deliver data via oracles on chain, so that we can actually publish the NAV to the issuer, so they understand what the value of the backing assets are on an ongoing basis, and they have confidence that they are maintaining their own backing assets to a level that they need to. And we also make sure that obviously the reporting and the administration around both the coins in circulation, but also around the assets that underpin the coins, that the administration and any reporting obligations associated with those are maintained on behalf of the issuer. So it's very much a 24/7 operation. It's very different to the way that we've operated in traditional fund administration. Of course, we've got a very robust and resilient infrastructure that we're using to support 3.5 trillion today in the private market space, and increasingly we are extending that out to support money markets and stable coins. So I think it's a very interesting area, but I think we've got to be able to give data. We've got to give transparency, as Rhys said. We've got to give consumer confidence that the assets that back those coins are appropriate, and that the level of coins in circulation is commensurate with those assets. So we're doing that in real time, 24/7, and it's a very important part. Even though a lot of people don't see what's going on in the Apex engine room, it's a part we're very proud of, and it's a very important part of the overall delivery.
There are a lot of cooks in that kitchen.
Yeah.
At the end of the day, I just want a nice warm meal, but you don't realize how many chefs are involved in putting that meal together on your plate and delivering it to you. So, I appreciate that explanation. Rhys, where are we headed? Final thoughts. What's your take on stablecoin adoption, especially in the institutional space, and how quickly are we forging ahead?
Yeah, I mean, I still think of myself as a sort of academic theorist, so I'm not trying to give you exact numbers. But I mean, I've seen, look, I've seen on the low end of projections, people talk about, I guess, 500 billion in the next few years. Total cap. I think that's probably a little bit sort of. I'm more probably optimistic than that. I've
Yeah,
seen things at the higher end of like 4 trillion or something.
trillions.
Okay. Obviously transactions are already much higher. I think people make the point that a lot of the transactions are still digital asset or on-chain transactions as if those are somehow not as valuable or not legitimate transactions. People say, oh yes, there's more turnover than MasterCard and Visa, but it's all crypto. I mean, I think crypto transactions, on-chain transactions have value, and as more and more of finance goes on-chain with real-world tokenized real-world assets and natively issued assets, more applications. I think we need to leave behind this idea that just because transactions are on-chain, they don't count. Okay, so I think stablecoins are going to grow very rapidly. To a large degree, it's gonna be related to the spread of just on-chain finance more broadly, tokenization and so forth. Okay, and I think the dam has all been breached a little bit on that now, and with the regulatory clarity, I think people are beginning to realize that there's huge value to be unlocked there. In a way, stablecoins maybe just be along for the ride. They're very important, but they are still just the cash. In some sense, the more exciting stuff are the applications. I mean, I think you can see, you mentioned institutional, but just also on the retail and
Yeah, that's
I
important.
guess so more smaller corporate side, you can see with MasterCard and Visa's experiments and with Stripe, you can see that these big players are putting quite a big bet, on growth in some sense real world usage, non-crypto usage as well. So we'll see how that goes. I mean, I think what will be interesting is whether or not the liquidity situation improves. I don't think this gets discussed as often as it should be. I think at the moment it's all well and good saying we can do immediate atomic settlement, but that's actually very liquidity demanding. And I think we're going to see if stablecoins really get going, it'll partly because we develop much more sophisticated clearing and netting services and so forth, which will really allow stablecoins to scale in their usage. Finally, I would say, again, I think yield-bearing stablecoins are coming. I think there are a few subtleties to be worked out, a few issues to worry about, but they will happen. And something else, at the moment, it's almost all US dollar. I don't think that will last. I think MiCA will be reformed somewhat. I think there will be a softening of views in Europe towards stablecoins. And I think ultimately, certainly sort of in Europe, for example, it's one thing to say a US dollar stablecoins are useful for an international company, but do people really want to be holding the US dollar when all their prices at the shops they go to are denominated in euros? Nobody likes foreign exchange risk, okay? So I think we'll see growth in UK, growth in Europe, growth in other jurisdictions. So this 99% US stablecoin, share, that will drop. Confident of that. But that, that's just a prediction that may be proved wrong. We will see.
No, hey, Professor, I'd bet my money on you and all the work that you have done. You used to work for the Fed as well.
Yeah, not in these areas though. I should say. But I was a theorist back then, so
I think in order to, you made a good point, not just from an institutional level, but in order to have widespread adoption, real world adoption, you need the retail person involved. Not just the institutions are there, great. But is everyone else buying into this? And at the end of the day, yeah, Angie, what does the demand curve look like from your perspective?
Yeah, so I think I mean, listen, a lot of the early use cases were obviously not regulated stablecoins. They tended to be mainly DeFi and retail oriented anyway. If you look at where we're now going with regulated stablecoins, by its very nature, a lot of the use cases are probably going to be very institutional in nature. So you're dealing more with sort of wholesale type payments, which because of that, the values of those payments will be much bigger than they would be in the retail world. So I think you'll see, in order to service wholesale markets for payment and for settlement, you have to, by virtue of that, have a lot more coins in circulation. So the fact that we're moving from just a sort of DeFi retail only type use of stablecoins to the full wholesale and retail circulation and use cases, I think will force much larger number of coins in circulation. I think there's a diversification of use cases. So quite apart from payments, which on its own will be revolutionized, I think, by stablecoins, certainly cross-border and in intra-entity movement of cash within the bowels of a single organization no longer needs to go outside through any payment networks. You can do it just using a stablecoin between the various entities within your parent group, right? But there are a couple of other big areas where I think we'll see a massive change. If you look at something like the EU pilot regime, I know it's got issues with the caps around the trading limits, but it allows you to trade a security and settle the security on chain. That and if you look at the what was very interesting with 21X recently, who are a partner of Apex's and a partner of Chainlink actually, they basically got their license with BaFin. BaFin is notoriously difficult to get anything from as a regulator. They've got very, very high standards, and they are going to be trading and settling using a stable coin on chain. Now that's securities. Okay, so you imagine that across many jurisdictions, and we're starting to settle securities on chain using a licensed stablecoin. That's game changing. If you look at hyperinflation, look at what Mission Bank have done in Turkey. They've launched a stablecoin, a licensed stablecoin, and their primary use cases to anchor to that to try to mitigate hyperinflation. I think you'll see that in many countries where hyperinflation is very common today. I think it'll be a very important use of stablecoins to give greater levels of security to the end consumer. So I think it's not just the payment world. I think you'll see a big uptick in the number of coins in circulation as we move more into wholesale and institutional. I think you'll see on top of that, as we get more regulation around security settlement on chain, I think licensed stablecoins can be used for that because it's all high quality liquid assets. And if we don't need to use central bank cash to settle, then it should qualify for that type of use as well. And then I think you've got these niche cases that are very powerful, like mitigation against hyperinflation. So I think it will grow exponentially, and I think it will go very quickly.
I appreciate both of you joining us today. One thing is clear, that these partnerships, as both of you mentioned, like those between Chainlink Labs and Apex Group, are very important. Apex Group is your bridge to scalable, trusted digital finance, and we're very excited to keep the conversation going and to help you unlock the future of finance today.
Thank you for listening to The Single Source, brought to you by Apex Group. If you enjoyed today's conversation, be sure to follow and subscribe.